It's come that time in which we will have our Trader Talk segment, and today we're going to be featuring Brett Manning, aka Chart Trader. Good morning, Brett.
Hey Jim, how are you?
I've been all right. So, haven't talked to you in a little bit. Just our
It's been a
schedules
while.
have kind of not really overlapped all that much. So, I got to get your take on what you're seeing in the markets. Quite a shifted mode lately. We had that big run up a couple days ago and gave that all back. I would assume you would call this that eat the tail type move that we've had, and here we are. I do want to highlight one thing. I'm looking at this SPY chart, and you can look at any S&P chart that you want. I drew a trend line that connected
Time frame?
a daily
Okay.
trend line connecting
Yep.
the December lows up to the August 7th low.
You in log or no?
I'm sorry?
Are you in logarithmic or no?
I think so.
Okay. So
So,
logarithmic daily chart, all right.
and all I did was just connect the low from August 7th, and it lined up with the low today. We bounced off that low. So,
You're not including the low from December.
no,
Or you're using the low from December, not including the low from May. Sorry.
Correct. Now I have a
Okay.
couple trend lines on the Trader Audio chart. The one I wanted to focus on mostly is the most recent one. So I'll do everyone a
And I
favor
think you're
here.
not in logarithmic, by the way. I'm
Oh, am I
thinking
not? Okay.
based on what I'm seeing right now. Yeah. But that's okay. Yeah, right. So I see. Yeah. So you could call this some version of trendline support. The other one we could do is go from May through last week's low to today, leaving out December.
Yep, we
See
could
what I'm
do
saying?
that as well.
And I think
I'll
that lines up really quite well too. In other words, we have slope support in play right now, and the question is, do we bounce a little bit and break through it? Which is my guess, quite
Yeah.
honestly.
And so that's why I highlighted this one because I know that is one of the things that you look for, especially when
Indeed.
you're in a sense where we've got that panic type situation where the put call ratio is really high. You've got a lot of fear creeping in. We've got the VIX above 20 now, and you want to see that blast through and maybe some sort of capitulation type move. And then a rebound back, which may be what you're looking for. But before you answer that, I do want to mention that Scalp Trader is putting on a second half size unit of CYBR. His stops remain at the 112 level. All right, Chart, you have the floor.
Okay, so yeah, I mean, I see a pattern like this. For instance, I think the simplest way to look at it is the slope line off of June 3rd through last week's lows and today's lows. It forms on a non-logarithmic chart, basically perfect slope support at the lows that we put in today. And you can probably see this across just about anything, a similar dynamic, even though maybe everything won't line up perfectly. But that dynamic is one that I do look to be broken through. But we have one of the big problems that I've had in this market for the last couple of days is we have the sense of there's such an aggressive lean to the market, and I get the sense that there's a very aggressive contingency of bears that see a vulnerability and are really going after it. And I think that there's something of a boycott from professional money on the bid at the same time. So we're not seeing the type of downward movement that I generally think is best to make money from the short side on, which is the type of movement where the sellers are longs who are leaving rather than shorts who are aggressively levering up. But this is still, this can lead to the other. So the shorts aggressively levering up can lead to longs leaving just based on a deteriorating technical tone in the tape. People just get to where they're far enough out of the money and they start to give up. And the way they got there is people hammering on the bid. And it's vulnerable to that because I think we've got somewhat of a boycott from professional money right now. And we've had it all year, and it's not coming back. We're not seeing somebody come in. We're not seeing a large contingency of professional money managers, as far as I read the tape, coming in to try and take advantage of weakness in the market to position themselves for the next leg higher. It doesn't feel like that kind of tape. There may be other reasons for that. We may start to see that. I said this morning I wanted to, I was leaving my mind open for the possibility that we'd start to see order flow that suggests that we're seeing, you know, big money players come in with the ability to assume more cycle risk again. Because yesterday it was extraordinarily absent. Seeing just the patterns, the way that they played out, the kind of order flow, the where the offer was managed from in terms of distance from the last pivot low and how aggressive it was, and where the ceiling, how fast the ceiling was dropping, and when we got close to any support level, how hard those market orders were coming through in the futures. Just trying to strip through a couple levels on the bid side, on the inside of the market, just to kind of prick things with a pin, and watch the stops drop out, and that kind of feel to the tape is something that, I didn't want to be dramatic this morning, but it's something I feel like I haven't really seen in the market in that way for at least the better part of a decade. I haven't seen the market feel like that. So that's what I meant by mode shift. It's a different face the market has put on right now. There may be other explanations for that. For instance, I don't know how to disentangle what's going on with GE. I don't know if it's possible that this Markopoulos report maybe leaked to people yesterday, and we started to get some of the, it passed around through IM chat rooms on Wall Street, and people started to position in front of it because the guy's got some serious street cred. And if GE were to be likened to Enron, that is a major event for the entire economy. That's not a little one-off, a company-specific issue. That's an extraordinary, that's a Lehman kind of situation. And Markopoulos has a tremendous amount of credibility, and if he's willing to go on the record and say that this is criminal fraud, I mean, he's saying this is criminal fraud. It's not some irregularities and a hole in the balance sheet that needs to be filled. If he's saying it's worse than Enron, then he's saying the entire C-suite of GE is going to end up either committing suicide or going to prison, because that's Enron. So if he's willing to go on the record with that, perhaps that's just flamboyantly clickbait for his report. I don't know. Maybe it's sensationalized, but he's got a reputation that allows people to at least feel like they've got to take it at face value at first. And if this is what he's really suggesting, that this is just a gigantic criminal fraud with a bunch of people who are headed to prison pretty soon and a bankrupt company that's going to be unwound, and it's GE. It sits at the heart of the Dow. It's a huge multi-decade kind of symbol of blue chip U.S. equity and corporate identity. And its impact on the corporate credit markets is massive. The corporate credit markets is a point of vulnerability. There's a ton of dominoes there. So I don't know whether maybe what we saw in the change of mode was related to people getting wind of something like that coming out, and we saw that underneath the surface of the tape. Or if it is, if we can disentangle the two and just say, this is just a sign of what's happening, of the sort of world that we're starting to move into, the sort of, dimension we're starting to live in, which is a bear market dimension. I mean, the tape we saw yesterday is a bear market tape. It's not a flash crackdown off the highs in a bull market that's a viable pullback. It was a bear market tape. And if we start to see, today, if it were to continue, what we see is a squeeze. I've been watching for a squeeze. I want to see a squeeze badly. I want to see that put call drop under 1.0. I want to see some kind of headline spurt, and then I want to see us feel that sense of, the market has just been massively displaced to the upside, and the fever breaks, and you just start to roll back over, and it'll get pretty intense back on the downside, and you'll be at a much lower level again when the put call's back at 140, and you got to cover. And that rhythm starts to establish itself. You get the slope of hope. Oh, everything's going to be fine. Oh, my God, no, it's not. And it just, rinse and repeat, and that's the trading rhythm of it. And if you see that, if you spot it, you can trade within that. But right now, it's sort of, I'm on the fence. We're seeing, the first few enemy troops, as Jesse Livermore used to put it, when you shift from bull to bear, start to race across. You see them in the distance. They're scouts. The army's not really here yet. Is that what we're seeing right now? Is we're seeing the beginning signs of something that is a transition in cycle? Or is this something where there's a couple of incidental factors that have caused people to behave that way for a short window, and it turns out that that was a misjudgment, and we start to see cycle risk again in the tape? And I don't know which it's going to be. But right now, I am starting to lean toward the idea that it's you will serve yourself better by entertaining the possibility that we've shifted that mode into the other side of the cycle at this point. And we want to watch for a tape that starts to heal itself on headlines in a slope of hope way, and then hangs everybody out to dry holding the bag, and then it just rolls over. And if that's the sort of tape that we're in, that will be tremendously lucrative if you spot it early. And I don't see a lot of, it may well not be what's happening, but I don't see a lot of risk to saying that at this point, particularly if you have some long side positioning. I still have, just an unlevered investment portfolio along the market, and I can say that. And I'm not going to make a call today to change that. I know that I'll make so much more shorting the futures than I would lose in that portfolio. There's not a lot of risk to taking that strategy, to putting on that set of goggles as I watch the price action right now.
I'm always curious, Brett, when I hear you and Gavin talk in the Flow Show that there is this money on the sideline. Big money managers are waiting for something to put money to work. Usually it's some type of pullback. They don't want to get caught into the FOMO trade. And we hear about chasing performance, and here we are. We've got the market down some, and then I hear you talk about a buyer strike. And I'm always wondering, okay, these are professional money managers. You have to assume that they know what they're doing. What causes I know, but at some point in the tape you want to see that action. Why do they get cold feet every time we get a pullback?
So I think it's this. I think the reason why they've been buyers, there's been a buyer strike on the upside. It's one of the fundamental paradoxes of the market that we've seen so far this year. We've seen a market that's performed very well, and we've seen money flowing out of stocks and into bonds like crazy, particularly among professional money managers. Now, there's a reason for that, right? There's a view on the world. You can see it showing up at the bond market like crazy. You look at all the inversions in the yield curves. There's a view on that. There's a view on that the upside that you can gain by getting long the market is nothing compared to the downside that you'll be risking given where we are in cycle terms. And I think that's it. I think that people operate according to the concept of a business cycle and a market cycle. Whether the Fed's research would confirm that or not, that's what predominantly 98% of Wall Street is willing to accept the concept that we have market cycle, business cycle. You've got an upside of the mountain, you've got a downside of the mountain, and they're different sorts of environments. And what environment are we in now? Are we in the very last gasp of the upside of the cycle as it's starting to turn into the downside of the cycle? I think that a lot of people, and again, I obviously with the way that I monitor sentiment data, that I generally speaking don't trust consensus conclusions in any way, shape, or form. And I believe up until I would say maybe yesterday, I believe that it's a similar situation to 2016, where you see people absolutely convinced that the cycle's over. Of course, it's time to be over. Stocks are way overvalued. Huge debt problems, et cetera, et cetera, et cetera. Time to start loading up the bear wagon. And you see that portrayed in sentiment data and in bond yields. And in 2016, let's not forget, was the record lows in the 10-year yield that we're still trying to shoot for now. We haven't gone back there, but that was the same type of thing. That was the idea that you've got, and I hope I don't go on too many tangents here to keep the thread, but the one concept, and I was having a conversation with somebody, a contact of mine, about this, and just the idea that the bond market could be seen as saying there's so much money out there and there's so little growth out there that it needs to find a place to be. And when you keep on increasing the amount of money out there, and yet it's not really impacting the amount of growth out there, this is what you're going to get: negative yields across the board. It's got to be somewhere. It's got to be somewhere where it feels the safest to not turn into smaller amounts of money in an aggressive and quick fashion. And people keep trying to stimulate things and add to more growth by putting more money out there. But that money out there doesn't have anywhere to go to find yield. It doesn't have anywhere to go to find growth. And so it just ends up sitting in bond markets around the world. And we can just keep on adding to that, and you just keep on getting more and more negative on yields. Both forces, central banks lowering the yields, markets lowering the yields. Too much money chasing too little growth. And I think that's kind of the trap that we're in here. And
Brett,
I'm not, well, yeah.
So I was just going to say, did you see the IYG this morning? That thing just continues to go high. I think that points exactly to what you're talking about here.
IYG.
Yeah, the investment grade bond ETF.
IYG? No, not IYG.
IYG.
No, not IYG. What is it? LQD?
Or LQD, I'm sorry.
Yeah, sure.
Yeah.
Right. I mean, you get a little bit better than, what you get. And that's we talked about that on Tuesday as well, that you've got the sense that people are playing a game there, and if they're not involved in the game, then they're taking a career risk, because what you need to do is take your money levered up 20 to 1 and put it in the thing that's just a little bit higher yield than government debt, but is not the type of risk in the risky tranches of corporate debt. And that's what this is, right? It's the top grade, and this is why the risk to GE is so crazy. If GE really is Enron, then this chart is the number one casualty, because you just start to slip down tranches. It just erodes the next tranche and the next tranche. And this is, hey, we don't want to make government bond yields, but government bonds, the rates are going to keep falling, and there's the lowest risk of default here, so we can make a little bit more than that in the blue chip investment grade debt. and we lever up our capital 20 to 1, and you've got big returns as a fund. And that's what we're seeing people do as the number one thing that they're doing in markets right now, period. And that's because you're just making more money and putting in a world that globally has very little growth and a lot of growth risks. And people are trying to find a way to engineer that into big returns. And it ends up being a lot of leverage into the thing, one notch up in yields from treasuries, and seems still to be relatively perfectly safe. And that's the LQD chart. And you're exactly right. That's a visual depiction of that dynamic. But it's not, that's not a really productive use of capital in terms of the concept of asset investment and capital markets driving capitalism. That's not, it's sustaining a process of buybacks, essentially, and keeping money feeling pretty safe and really taking more risk than it realizes, because you've got a lot of different people who are involved in the same leverage equation, and we've seen how that's worked out a number of times. So there's a genuine risk that that's become a consensus decision, and it's been driven that way by policy. But just to connect things up, I think that this is a market scenario that has a lot of potholes like that are keeping money from buying into the pullback. When you look at, to go back to your original question, professional money managers, their lack of exposure to the stock market in what still technically can be defined as a bull market. The S&P is above its 200-day. You look at the monthly chart, you can draw an upward slope trend line. Generally speaking, where the pivots have been, it's a series of higher highs and higher lows going back years that still maintains itself as the case. And we have sentiment that is nowhere near exuberance. And that would generally be a back-of-the-napkin formula for when you buy into pullbacks. And we're not seeing the money come in, but we also didn't see the money come in into the last highs. And I think that when you start to see the pullbacks, you get a bunch of people who get cold feet. They're not really getting cold feet, they're just keeping cold feet, because the market is just pulling back on the things that just reinforce the reasons why they were afraid to buy into the momentum in the first place. And that can persist. If you look at 2008, when we rolled over in November, December 2008 and into January, we saw some of the same things. We started to see a boycott of professional money before that, starting back in June, July of the previous year. The Fed helped stoke a little bit. They did a big discount rate cut, I think in August, and a policy rate cut just after that, and we moved the market back up. But the commercial paper market was completely frozen. You had a lot of professional money that was, this is a terrible scenario, and they stayed out of the way. Retail came in, pushed the market higher, and then sold it back off again. And the professional money wasn't there underneath it because they had friends at Bear Stearns. They had there's an understanding of what was starting to develop there, at least to a greater extent than in terms of what we would call dumb money circles. And the bid just stayed clear of that. And we started to pound it down. We had a big, really, really bad jobs report, I think, in January of 2008, and the bottom came out of the market. We started to rush down. We started to get counterparties scared. We started to see the whole 2008 narrative really start to take hold. But I think that was preceded by somewhat of a boycott of professional money. So it can work like that at the top. It's the opposite of the top we saw in 2000, where you had true exuberance on all parts, retail and professional money, in a lot of cases. really kind of just feeling like there was a new dynamic going on and fomenting a bubble. So there's different ways to make a top, but it's possible that this is a significant top. You don't see a return to that bid, and eventually you just see whoever are the strong hands in this market gradually get turned into weak hands, and that's how you get the equation for a bear market from here. It doesn't have to happen because we have the vulnerability of a lot of short interest, a lot of active shorting, and the possibility that things can heal if we get a trade deal with China, et cetera, et cetera. There are the conundrums that are in play right now are possibly ones that could be rescued by political solutions, and I guess you'd have to see a resurgence of professional money in the market. So it's a non-deterministic situation, but I think that's why you see the cold feet and maybe the boycott.
Well, here's something that I hadn't really noticed until now. I'm looking at the monthly SPY chart, and I want to highlight that time period between the, we'll just call it from early 2007, and you look at the way this chart forms. You've kind of got a peak, dips a little bit lower, we got another peak. That looks like it looks like our current time frame from
which part?
So I'm looking at
Monthly chart, SPY.
a monthly chart SPY. Go back to we'll just call it the early time frame of 2007, and look how that gets kind of we've still got that upward slope. That chart pattern right there looks very similar to what we have developing right here, right now.
It's Sawtooth. You ever hear that term?
No.
Sawtooth is the if you look at just really squint your eyes and look at any market top, you start to see sawtooth highs and lows. So rather than if you look at 2015 through 2017, the pivots are extremely tight and in a channel, or 2011 to 2014, pivots are extremely tight. And then when you start to see, oh, here's a 10% drop and then barely new highs, and then another 10% drop and then barely new highs, you get that sawtooth pattern. And it typically does mark, I mean, you can look at, you see the same thing, I think, on the same chart. If you look at 99 to 2001, you start to see a more erratic, wider monthly bars. Even if it's making higher lows and higher highs, it's in a sawtooth pattern rather than a grinding channel. Does that make sense?
Yes, it does. And one of the things that the next thing I was going to mention is just that historically, when you've seen these type of things, you'll see these type of wide ranges all of a sudden expand from out of nowhere, where we had this tiny volatility. And look what we've seen just over the last 2 weeks of trading. We've 30 point, 40 point, 50 point ranges, and getting that back the very next day. That's one of those vulnerable, one of those times where it's just there's a lot of vulnerability in the market, and that leads to where we can have some pretty sharp declines. So I guess maybe some money managers are pretty aware of that, and maybe that's what's keeping them at bay. However, then it sets up, if we do rebound and we start rallying, we have the end of the year performance chasing going on. So I don't know what to make of it yet, Brett.
Well, yeah, I think the big factor here is, do you think that it's possible that we could get a capitulation and a trade deal with China? I mean, I think that's the one factor that could meaningfully, truly be like a looking glass to step through into a world that works differently on markets. Maybe not, but that suggests itself to me that way, that there's a kind of, if we heal that factor and then we come into a year end with businesses starting to feel like they're more confident. Now, I mean, I don't think it's going to happen. So let me couch all of that by saying I think that that's a bit, like, is lightning going to strike exactly the same spot on my driveway today twice in the next 2 days? I don't think it's going to happen. But let's say if it were, and we've got an S&P headed for 3,500, I just don't think that's going to happen. But I think that there is the market is vulnerable on the upside to political solutions at this point.
All right. So at this point, you are waiting for your signals as to what to do as far as trading the indices. Is there any one particular that you're looking at more than the other? Maybe the NASDAQ over the S&P, or are you just waiting for which one shows you the best sign?
Yeah, so I mean, there's two ways to think about it. I generally, I'm favoring the NQs on the short side, just because in my experience, when you start to get the type of market where the professional bid's pulling back, retail investors maybe are holding the bag to some extent. Now, I don't think we've got a huge retail participation in this market, but it's still, I think that that's where you're going to get your puke selling. The Nasdaq at this point right now is more populated with individual equities that are more likely to be the focus of the retail investor, I think, right now. Mm-hmm. So that would be where I would see if we start to get some intensity on the downside. I think you're going to see the greatest chance of an air pocket. You slip on that banana peel to the downside and you get that quick jump of 30, 40 points. Yeah, I think that's probably I'm looking for all. I'm looking at all a group of different markets at the same time to get a sense of timing and where we are in terms of the phase of trend and in the pattern structure, and then probably likely if it's an equities short. I mean maybe not depending on the patterns and the others, but likely NQs on the short side. I want to see. I really want to see some of the air let out, though. The process that I talked about earlier, that sort of rinse and repeat pattern for this type of mode, it necessitates certain periods of quick upside shakeouts that rebalance the market in terms of short interest. And it's really hard. It's hard to just sit there and keep trying to pound on that bid when you start to see a sense that you're just one of a big crowd of people doing that, because where you're going to put your risk, it just takes a little flick. And you just set off a little cascade of people who are over-levered and too tight and just looking for that next 5 points or that next 10 points, and they're willing to just hammer into that bid to try and get it. But the second you move up 2 or 3 points, some of them cover, and that forces it up further, and then a bunch of other people cover. And it's really hard to manage your risk in that kind of strategy on the short side, and it's much better if you wait until all those people get shaken out first, and then you start to see the pattern set up. So I would like to see that. And we haven't. I think that we've seen a lateral range today, but we haven't seen anything that has meaningfully, I think, accomplished that work. And we're still sitting there with the put call at 136 to 145 over the last couple hours. So I would want to see that clear out, and then I want to see hope, a feeling of hope back in the market, a feeling of hey, maybe the bottom is in, and then I see signs in the pattern. No, it's not. And that's generally the best trading setups for me in a market like this. So I'd like to see that. I'd like to be patient. I'd like to let it come to me.
All right, I'm going to move over into crude oil, and I want to know if you've noticed a pattern in the intraday structure between crude oil and equities. And I'm not talking about a daily chart. I'm talking just if you kind of pinpoint a 10-minute chart, 15-minute chart, whatever time frame you want. They seem to move very close in tandem. And that
2 days ago certainly did, yeah.
Well, this is something that I've been noticing for the past 2 or 3 weeks, maybe even a little longer. It was somewhat anecdotal, and I didn't want to talk about it too much when I first noticed it, because these things can decouple at any given moment. But during the day, I have just noticed that if there's a move down in equities, there's going to be a move down in crude, vice versa. It almost doesn't seem to matter what the data is or what the headline is. They're going to move in tandem. And like, even I can just show everyone right now, I have the S&P chart and I have the in a crude oil chart right next to each other, and they consolidate right at the same time. My guess is that if there's going to be a breakout one way or the other, they're going to move together. So
the swing for swing correlation intraday.
Yeah, and it's
sure.
It's somewhat odd. I mean, have you noticed this, and is there a way to trade it?
I mean, it makes sense that would be growing now, because I think you're talking about an equities market that, if we leave the GE drama aside, appears to be a function now more of whether people are really contemplating the notion that we're rolling into a recessionary context over coming months in a much more tangible way. And that's, that pairs up the drivers pretty well. So I think that makes sense as a cyclical dynamic, right? Crude oil, highly cyclical asset, and the equities market, if it's operating in terms of cycle risk versus cycle aversion, then it would make sense that it would pair up, and maybe, I haven't looked at it, but maybe on an intraday basis with copper as well, though that's going to be so much more China driven. Yeah, and it doesn't appear to be tremendously in the same context. And probably inverse to the bond market to some extent.
Yeah, it was just something that I had noticed just over the course of the last at least 2, 3 weeks, probably longer than that. And because I used to look for these correlations all the time, and then they would decouple, and you couldn't trade them anymore. But that was always my MO. And anytime I found it, I was like, how do you trade this? Is there some type of leading indicator? Does which one leads the other? And I haven't really been able to find that yet. I guess it's just a function that they really are trading in tandem. How to make money from it? I was hoping you might be able to help, but
I don't think the correlation is going to give you an edge.
Yeah,
I think that it's going to be just something to observe and understand. It tells you a little bit more about the context that you're in.
sure. And that wasn't the answer I was hoping for, but the answer I was expecting. All right, so let's just keep going on crude though, and take a peek at this one again. We've had some pretty massive swings on daily chart, pretty wide ranges, and I'm pulling up a daily chart here in crude now, and it I don't see much. We're kind of in no man's land. I wish I could get a grip on what I might be seeing. I think that there's support kicking in around 54. I mean, obviously, we've got a couple of wicks that prove that, but is that 54 level vulnerable? What are you
I
looking
think so,
for?
probably. I'm looking for a move back down to break under 50.
Okay, and that would line up with what I'm looking at as well, where you got all these new longs from 51 to 54, let's say, that puts them in a very vulnerable state, and 50 psychological support, of course. What's it going to take to get there, though?
So my honest belief, trading crude oil for years and years and years, there's a dynamic here that if you're not used to trading crude oil, you will not be able to appreciate easily. So let me explain it. The pit traders in crude oil are jerks, and they will they will want to be short, and the way they will get that way is they will take your short away from you. And I would love to see it happen because I've seen it happen before. I want that type of setup. I want this thing to inexplicably jump to 58 in about an hour, especially into pit close, and then start to wheel back over. And that is just taking client orders and stuffing them through the system in front of the end of the day, and just squeezing the crap out of everybody who wants to be short, and then selling out of those and getting short. I mean, that's, the people who are dealing with those client orders and are managing that level of order flow. They've been known to do it quite a lot, especially when there's a key level. We used to see it around the 100 level when we were up above it, and we had so much CFTC exposure in the net spec category, and we were looking for that rollover, and Saudis were not really saying they were going to protect the level, and you're bouncing around it, and you're thinking, I got to short this. It's going to break 100. It's going to be at 95 10 minutes later. And, it goes from 100.3 to 106 in about an hour. And then 2 hours later, it's at 96. And it's just that process of just shifting who gets access to that position by just bullying the market around. And it's notoriously the case in the crude oil market. And if this is a big deal, to break under this 54 level, if that releases a trapdoor to head back down to 50, I think that you've got maybe a couple days on that, maybe not. I would like that to be the case. And the setup that I really want to see is then a squeeze that just makes no sense. A squeeze that just makes no sense, particularly if it's in the last 30, 40 minutes of trading. And I just get the feeling that you've got people who really want to be short, but they know that they've got a quota of client money that needs to be buying. I mean, it could be people hedging, who are, you've got, for instance, buyers in this market, in a commodity market. There's a lot of different buyers, and it doesn't necessarily have to do with tactical time frame positioning. Example I often use is if you're American Airlines, you may not have enough hedges in place. You may have had a meeting and decided that you need to have more hedges in place against a rising cost of jet fuel because of tensions in the Middle East. They're not making a bet on, trading crude oil. They've made a decision about how they're going to manage their next quarter so they can report, where their average price is guaranteed, is locked in. Because if you get something that jumps up the price, they don't have enough hedges, then that's a floating variable for them. It can actually impact how the company performs. So they need at times to buy, another 200,000 or 300,000 contracts of different expiries in the crude oil futures market, because jet fuel is almost perfectly correlated with crude oil. And you've got people who work for firms, and they've got traders on the floor, and they need to position those orders, and that's ammunition. And that can be, if those orders are timed at the right point, these are traders too. And if they can force a big squeeze with that and turn around and then get short on everybody who's covered, then they're going to do it, especially if they've got a strong near-term bias and conviction. And I'm just telling you, I've seen it happen 1,000 times. So I would like to profit from a short in crude oil from this rough area. I would like to see a better opportunity than this exact short time frame pattern. And I think that there's a little bit more time here, and I think that we're going to gradually see this. The thing that I talked about a couple weeks ago even was this gradually move into looking like a descending triangle pattern with the trigger level at about 50.5. And then we start to explore maybe quickly down to 48.50 or 48 or 47.50. I'm not sure that this just opens up from there, because the other factor here is where the horizon has shifted to in terms of where the majority of shale production can be profitable, and it's become such a flexible system that I think the market has a tough time, dropping too much through the floor because of how supply starts to constrict at lower prices from the U.S. And it's possible that, we're going to see that kind of process. We break this, we get a descending triangle formed, we break down, we explore the area under 50. Maybe it doesn't follow through that much. But we'll see. We'll see how the market feels after you started to test those levels. I think that it will.
All right. Well, it's a trade you have seen 1,000 times. I hope we see it 1,001. So.
Me too.
All right. So keep us posted on that one, especially if you see it beginning to develop, and we'll reference this segment so that we can talk about it a little more if and when it does come to pass. All right, Brett. Now I gotta bring up the move in the euro. We had a decline today. Let me get this chart out of the way. So we had a decline today because who was it? I know Gavin talked about it. It was an ECB. I don't know if you saw it. Well, anyway, he said that.
Olli Rehn.
Rehn.
Okay.
Olli Rehn, the Finnish president, basically said that the market should expect a package in September that's greater than what their current expectations are. The idea being that you have to do a lot at the beginning rather than try to piecemeal it and avoid losing any sort of credibility, was his thoughts.
All right. Yeah.
So this goes back to the theory that I was discussing earlier about let's just make lots more money and it will end up just finding its way into the bond market.
All right. Finally, got a euro chart. And so, well, it did. I'm guessing it did pretty much what he wanted to. Make the euro sell off. That's basically what you would expect it to. Where are people leaning in the euro right now, and is there vulnerable to the squeeze to the upside now that this is kind of out of the way?
We last time we did talk a couple weeks ago, I noted that 3 weeks ago, it's been a while. Mm-hmm. I noted that the problem that we had earlier over the summer and the spring with the euro short idea was that it was crowded net spec short in CME futures, and that had gone away for the most part. Do you remember that conversation?
Absolutely. Yeah,
so we're still there. We're still in a situation where the downside is open field. People can go after it because it's not really crowded. It's a little more crowded than it was then, but it's not prohibitively crowded. So I think that that's very possible, especially if we continue to see rhetoric from the Fed that it's back in the divergence direction, at least to some extent, and obviously we've got what's it called? Wyoming, Jackson Hole, coming up, and that's going to be enormous for this, for currency markets in general. I think the Jackson Hole is finally really, really important again. And what is that? The 23rd? Is that about a week away? I don't know if you have still.
Yeah, it's the 23rd to the 25th, I believe.
Yeah, I mean, that's going to be the most significant thing happening in global monetary policy this year, I would guess at this point, because there's so much focus there now, and that's the big stage to kind of that they've utilized in the past for delivering a sort of multi-meeting message about, guiding presumptions, and the market's going to need to understand where that's heading, and if the United States is starting to capitulate toward more intense convergence. In terms of not wanting the rest of the world, you're going to see this from the ECB. You're going to see this from other places where they're going at a faster than expected pace of easing, and the Fed would need to do the same thing to play catch up and not make the world's reserve currency something that's divergent in terms of its policy framework. So how they're going to deal with that is going to be important. It's certainly going to impact this trade. But yeah, I mean the downside in the euro is open field now because we'd reset and rebalance that market to some extent.
All right, so let's see. We got to talk about gold a little bit. GLD, you're out of it.
Was that nice?
Yeah, that was a good one. And everyone wants to know, how'd you time that so well?
I waited until longer than I should, and then finally decided to close it.
All right, so
I mean, I was fortunate. It looks like a really, really spectacular trade, and really, it was a good trade, and I got lucky.
Well, we're now back to basically where you got out of that trade. And so, I don't know, we probably didn't get the type of pullback you would have wanted to see to even think about putting it back on. But
no chance.
But,
right.
Where do you think gold is going from here? Is there a still some more upside? I mean, looks like this thing wants to continue to break out.
It does. It does. I'm not going to fight it. I'm not going to join it. As Jesse Livermore once said, don't worry about the first eighth or the last eighth. I assume there's going to be another eighth. I'm not going to deal with it. We've got 300,000 net long spec now in gold. It's a multi-year high kind of situation in terms of how much speculative long money is in gold. It could just keep going. It could become 500,000, and this is at 2,000. I'm not going to worry about that. If that happens, that is not something that I'm going to kick myself for. I managed the position and the process according to the window that best matches what I see as my edge as a market participant. And whatever else happens, and I don't worry about it. I would believe that according to how I normally look at these things, that we have too much of a crowded momentum long going right now in this trade. It could certainly escalate dramatically, particularly if Mr. Markopoulos and his research team appear to be, end up starting to appear to be correct, and that has repercussions for the, up the ladder of tranches in the corporate debt markets. If we start to see everything slide down a notch, then you've got a lot of money in that tranche just above, where it starts to slide into contemplating junk, and that turns everybody into sovereign debt and gold monkeys who are just going to ramp this thing again. So I can see it. But working against it is what we just talked about with the euro. And if the Fed is in a situation where they could precipitate a runaway move higher in the dollar, that's not usually the best circumstances for gold. Can be. The two can move together in a situation where it kind of moves into what I call the four horsemen of the apocalypse kind of market mode, when you get the yen and gold and bonds and the VIX all moving together to the upside. With the dollar. The dollar and the euro, or the dollar and the yen, tend to start to become kind of together in the currency market, along with gold and bonds and the VIX, and you get that sort of real deep cycle risk trade going on. Gold could extend quite a bit from here, but I'm watching the patterns for them, but I'm unlikely to move into anything like a larger time frame. I may scalp on the long side, but I'm probably not going to worry about trying to rejoin the trend until we see something that's much more significant as far as shaking it out.
All right. Any other markets you think we need to cover before signing off today?
No, I think it was pretty comprehensive. I mean, I think we didn't really talk about the trade war very much, and that's fine because everybody knows pretty much what's going on there. I think that, we're in the same situation we are. I think that one last point I'll make, I think it's interesting that they made the shift around the 80 billion tranche to move it to December 15th. For a couple reasons. One, I would imagine that list of products was picked, just my guess. I mean, analysis will show, and I haven't looked at it that closely, but it makes a lot of sense to me that that's actually a list where it's seasonally biased toward the period that's between now and December 15th, which means it's actually worth much more of a part of the ratio than it is, 80 to 220. It's actually maybe about even in terms of what the next several months are going to look like, because that 80 billion per annum may be mostly packed in to the holiday shopping period for the things that were put on that list. And the other 220 may be seasonally shifted the other way, and that may be how they tranche that out. So it's actually more easing than it looks. It's actually being softer than it would appear. But the main thing that it says is, it appears to me to be a de facto admission that the tariffs are causing economic problems, because you wouldn't make that decision if you thought that, regardless of context, that the tariffs are a completely unimportant factor in terms of how sales go for things, how economic activity proceeds. If you want to make sure that the tariffs don't impact how much sales flow there is through the holiday shopping period, then, if you do this to try to solve that, then you're very openly stating that the tariffs are a negative factor for economic activity. And it seems like, coming from the White House, that's an important step.
Yeah, I did find that timing somewhat interesting as well. And I guess time will tell to see how that plays out. I guess the good news is, though, that the consumer, the retail sales number was all right. And I guess we'll wait to see for any more color from some of the retailers that are yet to report, to see what they have to say about the landscape. And of course, we're going to be setting up for the holiday season. It's not that far away. School's already starting, and so that'll be the next commentary that we'll be looking forward to. We're halfway through the quarter right now, so I assume that we'll have some updates on conferences. So it should be interesting and keeping us busy over the course of the next several weeks. So, all right, Brett, I think that covers a lot of. Go ahead,
guys.
Gavin.
Sorry to interrupt. And if you addressed this, I apologize. Somebody was just asking on feedback, different ways to play Crude if they're not joining you into futures. Brett, I don't know if you addressed that or not, but maybe some different ETF vehicles that people could be on the lookout for to join you in that trade.
Yeah, I would say, quite honestly, short UWT would be the preferred vehicle. If you can short, some people are playing instead of retirement accounts where shorting is not possible, and that makes it more difficult. But UWT is a leveraged ETF that is built on ultimately futures exposure in crude oil. So you will be getting potentially even a percentage advantage over the futures. I'm much more comfortable transacting in the futures, and they give me round-the-clock stops, and that's the big thing that you lose with shorting UWT. But the advantage is, yes?
Have you played in the ERY? It doesn't look like nearly as much
equities.
volume there, but
that is equities.
The ERY is the 3-time energy bear ETF.
Yes, but it's equities.
Okay, I got you. I hear what you're saying.
And they in this current context, they are divergent from crude oil. Okay. I don't know whether that will continue or not. I don't know whether that a breakdown in crude oil will necessarily mean they pull back. They've missed out on rallies in crude oil, and now suddenly are rallying with crude oil weak, and I don't know what that's going to work out like. So I would stay toward actual oil, and if you're looking for an ETF solution for that, the advantage with UWT is if you stick around in it on the short, you can stick around in these things on the short side, but not the long side. So Gavin did a fantastic job with his UWT swing long recently, because he pegged it right from the start that it's just a couple days kind of thing. If you sit in there for weeks, it's a problem, because you get a factor based on the mathematics of leveraging these ETFs through interest rate swaps and the other various factors that they use. There's a process that causes it to erode. And you can see this quite simply if you look at something like UWT versus crude oil, or if you look at you can look at TQQQ, I think is the NASDAQ long. Look at it relative to QQQ when you look at the weekly chart. you can see how much TQQQ has underperformed QQQ on the weekly chart relative to highs. It's way below, for instance, its highs from 2018. That's a good example of the decay or the deterioration that happens in any leveraged vehicle. And I can post something that explains the math on that. I posted it a million times before, but for newer subscribers, I'll post it again after this call. But it shows in a relatively incontrovertible way how the mathematics underlying leveraging causes an inevitable deterioration in price. So when you short these things, you actually gain from that. And that's why oftentimes leveraged ETFs are hard to find short shares, because there are hedge funds that exist solely to take take advantage of that factor. Right? They'll have deep enough pockets to be able to withstand rallies, and they know that if they just sit there, short these things, over time they will decay in price. So you gain that advantage that this goes sideways for 6 or 7 days and then rolls over. UWT will actually go down over that 6 or 7 days for the factors that I'll explain in my post. So UWT, the advantage is it actually has a mechanical downward bias. So shorting it is mechanically advantageous. The disadvantage is you do not have an overnight stop. And if you see a situation where tomorrow night, in the middle of the night, you're short UWT and I'm short crude oil futures, and there's a China trade deal and a new peace resolution in the Middle East between Israel and Palestine, and Iran and the Saudis are shown hugging, you're actually going to have a huge advantage there. So let's say the opposite happens. We get a big explosion in the Middle East, and there's a Chinese trade deal. You're going to wake up. You will not have had a stop trigger. You'll be down 30%, and I will, in my crude oil position, have been stopped out for a very small loss. So that's a huge difference too. So when you're trading UWT, you've got a mechanical advantage on the downside, but you've got a huge disadvantage with no overnight stop protection. So you just need to understand in your sizing that that's the case. But the answer to the question, I would say, is shorting UWT.
And then there's one more that you can use in the futures market if you don't want to use the full crude oil. I've talked about it before, but I was able to finally look it up and confirm that the E-mini crude on the NYMEX is the QM. So QM, Quincy Mary, is the symbol if you want to do the E-mini. Yeah. So and it trades half the size. So it's in different increments. But if you want to trade, not everyone's got a big futures account. Maybe it's something that they play around with. Now, if you do two QMs, that's the equivalent of one big crude oil, and therefore if you want to play it so where you can take off half of it, because you can't take half off of one, you can play it that way. And granted, you'd be using I don't know what the commission rate is. It's probably the same as what the big CL is, but I think you guys get the gist. You can play that. I'm going to take a partial profit game that Chart Trader plays, where you can lock in some profit and work your stop accordingly. So that's another way if you have a smaller futures account and you don't want to take it, or just trade half the size. It's a an easy way, a cheeky way to participate without taking as big a risk. So there you go.
All right,
Brett. So I guess that wraps up this segment. And as always, my man, thank you for coming on and giving us that perspective. We always love it.
All right. Thank you, Jim.
All right.